Bitcoin has long been the subject of debate, with one of the most persistent arguments being that it is not backed by any physical asset like gold or fiat currencies. Critics often point out that Bitcoin does not have an intrinsic value. However, this perspective overlooks the unique factors that influence Bitcoin's value. Unlike traditional currencies, Bitcoin's value is primarily determined by the sentiment of its holders, its scarcity, and market demand. It is a purely decentralized asset that operates without the backing of any government or institution. This makes it a unique form of investment, driven entirely by market forces and the trust that its users place in it. As the largest and most well-known cryptocurrency, Bitcoin's market dynamics are closely watched by investors and analysts alike, not only to predict its future movements but also to gauge broader market sentiment. Volatility is a defining feature of Bitcoin and one of the key reasons it attracts both interest and skepticism. When compared to more traditional financial markets like the S&P 500 or Nasdaq, Bitcoin exhibits nearly double the volatility. This means that its price can swing dramatically in short periods, which can be both a risk and an opportunity for investors. Despite these sharp fluctuations, Bitcoin has consistently demonstrated an ability to recover quickly after significant dips. This resilience points to a deep, underlying demand for Bitcoin in the market. Unlike traditional stocks that may take months to recover after bad earnings reports or economic downturns, Bitcoin often rebounds within days or weeks. A prime example of this was the German state's sale of Bitcoin, which initially caused a price drop. However, the price rebounded swiftly, illustrating the strength of demand. This pattern of sharp declines followed by quick recoveries reinforces the notion that Bitcoin's liquidity market is both robust and capable of absorbing significant volumes of trade without long-term disruption. Liquidity is a critical factor for any market, and Bitcoin's liquidity presents both opportunities and risks. One of the emerging concerns is the impact of Bitcoin exchange-traded funds, ETFs, on market liquidity. Bitcoin ETFs operate on a T+1 basis, meaning that if an investor buys a share of a Bitcoin ETF on Monday, the fund buys the actual Bitcoin the following day, after the markets close. This delay can create risks, particularly if there is significant price movement over the weekend when Bitcoin markets remain active, but ETF markets are closed. If the price of Bitcoin drops sharply over the weekend, the ETFs could be purchasing Bitcoin at unfavorable prices on Monday, impacting the overall market. Another concern is the concentration of Bitcoin ownership. Large entities, including governments or corporations, holding a significant portion of Bitcoin could further limit market liquidity. For instance, if a few major holders decide to sell large amounts of Bitcoin simultaneously, it could overwhelm the market's capacity to absorb the sell-off, leading to significant price drops. Moreover, the fact that around 20% of all Bitcoin keys are lost, meaning the associated Bitcoin is inaccessible, exacerbates liquidity challenges. These lost coins reduce the available supply, further concentrating liquidity risks. As a result, understanding these liquidity risks is crucial for both institutional and retail investors. As Bitcoin matures as an asset class, there is a growing demand for derivative financial products that can help investors manage their exposure to Bitcoin's volatility. Derivatives such as futures, options, and swaps allow investors to hedge their risks or speculate on Bitcoin's price movements without holding the actual cryptocurrency. The introduction of these products is likely to bring more liquidity to the market, making it easier for large investors to trade Bitcoin without causing price swings. Derivatives also open the door for more sophisticated trading strategies, such as shorting Bitcoin or hedging against potential losses. In the oil industry, for example, derivatives play a crucial role in stabilizing prices by allowing companies to lock in future prices, reducing the impact of volatility. A similar development is expected for Bitcoin, where derivatives could help smooth out some of the extreme price fluctuations. In the next few years, we are likely to see the introduction of more complex Bitcoin derivatives, which will cater to both institutional investors and retail traders. This will create a more mature and stable Bitcoin market, where price movements are driven not just by sentiment, but also by more rational trading based on market fundamentals. Fred Thiel, the CEO of Marathon Digital Holdings, has argued that the United States should consider holding a national reserve of Bitcoin, much like its gold reserves. The US is the largest holder of gold in the world, using it as a strategic asset to project financial power globally. Although the US dollar is no longer backed by gold, having large gold reserves provides the US with significant leverage in global financial markets. Thiel suggests that Bitcoin could play a similar role in the future, especially as the US faces growing national debt. Holding Bitcoin as a reserve could provide a hedge against this debt, as Bitcoin is expected to appreciate over time. If the US were to acquire a substantial amount of Bitcoin, say 2 million coins, and if Bitcoin's value were to reach $20 million per coin over the next few decades, this would give the US a strategic asset worth $40 trillion, more than enough to cover the current national debt of around $35 trillion. Thiel's proposal is based on the belief that Bitcoin's long-term value will increase as more countries and institutions adopt it. If the US were to take this step, it would likely trigger a wave of similar actions from other countries, as no nation would want to be left behind in this new financial paradigm. The idea of Bitcoin becoming a sovereign reserve asset has far-reaching geopolitical implications. Countries like Russia and China are already looking at Bitcoin as a neutral currency that is not controlled by any single government. This makes it an attractive option for countries that want to trade outside of the US-dominated financial system and avoid sanctions. If the US were to hold a significant amount of Bitcoin, it could maintain influence over the global Bitcoin market, just as it does with its strategic petroleum reserve. However, other countries would also want to ensure they are not at a disadvantage, leading them to accumulate Bitcoin as well. This would create a decentralized global reserve system where multiple countries hold Bitcoin to safeguard their economic interests. Moreover, for national security reasons, countries may start investing in their own Bitcoin mining operations. By controlling mining pools within their borders, countries could ensure that they are not dependent on foreign mining operations, which could be subject to sanctions or other forms of economic pressure. This decentralization of Bitcoin mining would not only enhance the security of individual countries, but also make the entire Bitcoin network more resilient and less vulnerable to centralized control. The future of Bitcoin mining is likely to be characterized by greater efficiency and a shift toward the use of renewable or underutilized energy sources. Bitcoin mining has been criticized for its high energy consumption, but innovative solutions are emerging to address this issue. One example is energy harvesting, where excess or wasted energy is captured and used to mine Bitcoin. Thiel's company, for instance, has developed a system that uses the heat generated by Bitcoin mining to provide heating for homes. In Finland, they are using this technology to heat 11,000 homes with the energy produced by a 2-megawatt Bitcoin mining facility. This approach not only reduces the environmental impact of Bitcoin mining, but also turns it into a dual-purpose activity that benefits local communities. As more countries invest in Bitcoin mining, we are likely to see a race for efficiency, with miners competing to find the most cost-effective and environmentally friendly ways to mine Bitcoin. This trend will be particularly important if Bitcoin becomes a global reserve asset, as countries will want to ensure they can mine Bitcoin in a sustainable and economically viable way. Over time, this could lead to the development of a more decentralized and efficient Bitcoin mining ecosystem, with countries around the world contributing to the security and stability of the Bitcoin network. The market sentiment surrounding Bitcoin is often a reflection of broader economic trends, regulatory developments, and technological innovations. Currently, Bitcoin options are set to expire, and traders are preparing for potential volatility in the market. The put-to-call ratio, which compares the volume of bearish put options to bullish call options, stands at 0.61, indicating a slightly bullish sentiment. This means that more traders are betting on a price increase than a decline. As we approach the expiration of these options, which have a potential value of $3.6 billion, Bitcoin's price could experience sharp movements. Analysts are keeping a close eye on the maximum pain price, which is the price at which most traders would incur losses. This is currently set at $61,000, close to Bitcoin's current trading value. Looking ahead to future expiration dates, the sentiment becomes even more bullish. The expiration in late September shows a lower put-to-call ratio of 0.56, with a significant number of traders betting that Bitcoin's price will exceed $49,000 by that time. Further out, the December expiration date shows an even more optimistic outlook, with traders expecting Bitcoin to reach $100,000 by the end of the year. This long-term bullish sentiment reflects the growing confidence in Bitcoin as an asset that will continue to appreciate in value over time. In conclusion, Bitcoin's evolving role as a global asset is reshaping the financial landscape. Its value, driven by sentiment and scarcity, is solidifying its position as a pure form of investment. While Bitcoin's volatility presents challenges, its ability to recover quickly from market downturns highlights the strength of demand. As more financial products like derivatives are developed, Bitcoin's market will likely become more liquid and stable. Fred Thiel's vision of a future where Bitcoin is held in national reserves represents a dramatic shift in how governments might interact with cryptocurrencies. The geopolitical implications of such a move are vast, potentially leading to a decentralized reserve system that empowers nations outside of the traditional US-dominated financial structure. Countries will also likely increase their involvement in Bitcoin mining, creating a more decentralized and resilient network. Finally, as Bitcoin's market matures, bullish sentiment indicates that its price could reach new highs, further validating its role as a strategic asset. Bitcoin's future is both exciting and complex, with the potential to disrupt traditional financial systems and create new opportunities for both investors and nations.